There's something like £80 billion in them today, and by many forecasts it could be as much as £125 billion by 2018. I'm talking about diversified growth funds. I'm Mark Colgate, and this is Institutional Masterclass. I'm joined by a trio of experts to discuss the sector. They are Mark Parry, Senior Investment Manager at Aberdeen Asset Management, Aniket, Vice President at Redington, and Robert Holford, Senior Consultant at Spence. Robert Holford, how would you define diversified growth funds?
So we define them as sitting between traditional balanced funds and more active sort of hedge fund type strategies. Generally speaking, we've seen three different types of diversified growth fund depending on the level to which they are strategic or tactical. And moving from the more strategic end, we see funds that manage a strategic allocation quite a sensible way, towards a more tactical, where there's a sort of tactical overlay to the strategic aspect, towards a more absolute return, which is getting back towards the traditional hedge fund type structures. In addition, we see diversified growth funds being generally more transparent, lower cost than hedge funds, but again higher cost and a bit more complicated than traditional balanced.
Aniket, I mean, that sounds quite a mix going on in that sector. Is it really a product or more of a marketing banner?
So yes, I think very much so. It's a marketing tool, a brand as such. I think Spence Johnson referred to it as a brand, and I think we'd wholly agree with that conclusion. The term DGF, it's come to mean a lot of different things to different people, but in essence it's referring to basically multi-asset products with certain characteristics as Robert has pointed out. Basically you're seeing kind of different asset allocation techniques used, but generally using dynamic asset allocation, that's a key tool. And within this set you see even more kind of differences evolve. So to start off with, you see some funds having a kind of neutral asset allocation and kind of tilting up or down from this kind of neutral allocation, whereas others just basically take a kind of benchmark-free approach, so that there's no such kind of neutral benchmark in the back of their mind. So that's the kind of evolution you're seeing within these funds.
There's a huge amount of choice. Mark Parry, where do you fit on that spectrum?
Well, there is an irony, is there not, that there's a huge diversity of diversified growth funds. For us, it's very simple. It's about delivering a real return and smoothing the path of that return. So it's about accessing not just growth assets, but a variety of assets, trying to aim at a return of cash plus 4.5% in our particular case, but to achieve diversity in doing that, i.e. reducing the risk to smooth the path of volatilities and to provide a smoother return for our investors.
And just to be honest, you mentioned making a real return. Is that different from an absolute return?
Well, so what we say is that we believe that over time, the long run return from equities should be in the order of cash plus 4.5%. That's based on real economics. And we think we can try and deliver that by investing in markets. So we're going to have a degree of exposure to capital markets to generate that return. What we're trying to do, though, through active allocation, through diversity of holdings, is to smooth that path of return over time.
So how much less volatility than equities would you be targeting?
Well, we'd say formally a target of around 2/3 of equity volatility over the long run. But let's be very clear here, what we're not doing is actively seeking to raise volatility to that level just because, but we believe that equity-like returns but with less volatility should be an interesting opportunity set for a variety of investors.
Okay, and I could bring you back in that. I mean, that sounds very attractive, the return of equities, but with 2/3 of the risk, or certainly 2/3 of the volatility. Is that a realistic target to go for when you look at the DGF sector?
I think in general, you have to appreciate that on a kind of risk-adjusted basis, a multi-asset framework generally does lead to better outcomes than using a single asset. If you use kind of portfolio theory, that does hold up. So I don't think it's unreasonable as such. The exact parameters around, exactly cash plus 5 with 2/3 volatility, on a long horizon that can hold, but clearly on shorter horizons that might not hold. And to some respects, it does kind of reflect the kind of the returns that are on offer within the market. So if the market in general, as at the moment, you generally tend to see kind of lower returns within the major asset classes, you are going to get a somewhat lower return overall if your focus is within the major asset classes. So I guess it is somewhat environment dependent in terms of what's achievable, but over a long term, I think cash plus 5 with 2/3 volatility has been shown to be effective.
And Robert, I mean, you were mentioning at the start there's lots of different. I think you characterised 3 different types of diversified growth fund. Are any of those types of fund more likely to produce higher returns than others, just from the techniques that they use?
We haven't done a lot of work on looking at sort of how the outcomes essentially affect this, but I would say that the majority of funds being offered in the market are the dynamic type funds, although obviously absolute return has a lot of assets in it as well. There's very few funds offered in that space. The majority are dynamic. They are seeking to produce returns in a way that is a bit more tactical than has traditionally been possible through asset allocation strategies in traditional traditional pension fund type structures. So really we see this product as one that solves the problem for traditional sort of defined benefit and consultants where they're focused on the more strategic asset allocation. This comes in and actually provides a means by which you can tactically allocate more sensibly using the experts, if you like, in the investment management industry to help you do that.
Okay. And Mark, I mean, just coming back to sort of the short versus the long term, I mean, 2013 has been a very good year for the fund management industry. Should people be wary of thinking they can get 2013 figures from 2014's markets?
2013 was an extraordinary year. Stock markets in particular roared ahead. I think it is unlikely to be repeated. There was a big re-rating going on. There was a few other things in the background as well. Generally speaking, over time, equity markets should give you nominal GDP plus some dividend plus some sort of profit growth effectively. That's a naturally anchored rate of growth. Some companies will do better than others, for sure, but that's a sustainable long-run return. That's kind of a high single-digit number, maybe low double digits. 30% plus, unrepeatable, I'm afraid.
So when you sit there in 2014, I know you won't look at markets calendar year by calendar year as such, but is there a point where it affects your mindset as you start to look out at the future and think, this has got to be a glass half empty kind of year?
Well, there's a famous phrase, isn't there? If you wanted to get there, you wouldn't start from here. I think what matters are what are the key drivers of markets. If we think about risk markets, that would be economic growth momentum, valuations and liquidity. All of those things right now are modestly, though not maximum, positive from our perspective. Given where we're starting from, that gives us a positive outlook for equities as an asset class, but I think a degree of caution. We require further progression on the earnings front, probably to drive multiples further after the re-rating that we've seen. But compared to the immediate post-crisis backdrop, the economies are much, much healthier than they were. But I still think it's right to just try and temper people's expectations that a repeat of last year is most unlikely.
And Aniket, as you're looking at this, are there any sort of, particularly when it comes to diversified growth funds, are there any big plays that you think, if the manager's going to do well, he or she's got to get this one right in 2014?
I don't think there's a single thing that we identify. As consultants, we generally tend not to kind of call plays and call markets that managers. This is what we're looking for. Generally, we leave that to the manager's discretion in terms of making the calls, making the plays. One thing I'd note is, I guess, observing kind of lower returns in kind of major asset classes. That's ongoing theme. You're tending to see managers use what we term kind of alternative risk premia. So basically not looking at just traditional asset classes, but looking at strategies within asset classes. So kind of long-short strategies. So basically things which don't need markets to go a certain way. You're starting to see more use of that within diversified growth funds. And as you see this, it's almost as a kind of evolution of funds within the DGF category. And there's basically less reliance on markets going a certain way. And especially when markets are uncertain, we're seeing more managers use this. So that's something I think a lot of managers within the DGF area are looking at pretty intently.
So you're saying that if you poke around in alpha for long enough, you actually find most of it's beta, it just hasn't been codified yet?
That's definitely one way to kind of look at it. What one person's alpha is, it can be beta to someone else. And as the market goes along, it's almost the expression is alpha just beta waiting to be discovered. So that's a very kind of interesting philosophical question, and I guess we're starting to dig a lot more into kind of detail around that. But
well, let's, Mark, can we get a sort of response to that?
Yeah, clearly, any strategy that invests in underlying markets is going to be subject to the variations of those markets. That's a given. To make capital gains, we need to commit capital to those markets, and they have a degree of risk attached to them to generate those returns. You can't break that equation. What I think you can do, though, is choose your allocation both at a strategic level, so what combination of assets today as a starting point is likely to give me a set of returns and a set of risks that I'm comfortable to own, and to tactically allocate within that as well as markets move ahead or behind of where we think they should be. What we can try and do is avoid the permanent loss of capital through investing in entities that basically go bust. But any investment in any form of capital markets is bound to be subjected to the vagaries of the markets you're invested in. The question is whether there's a more efficient, a more effective way of accessing those markets. And we think a diversified growth strategy is one way of doing that.
Robert Holford, I mean, I mentioned in the introduction that you guys were thinking that DGF market is one that could be £125 billion by 2018. Are you seeing prices coming down on diversified growth funds, and is that one of the things that's going to make them more attractive?
No, I think for the most part we see that the market is quite reasonably priced at the moment. Prices might come down a bit, obviously, as strategies grow and as the market itself grows, and you get scale from some of the major players. But our main drivers of growth, in our estimations at least, are the DC market, where we've seen a lot of large trust-based schemes put DGFs into their strategies, and those strategies have yet to attract significant assets because we're just at the start of the auto-enrollment process. So as DC begins to attract assets, we see a natural growth there. And also we've seen sort of interest among smaller DB schemes. We recently participated in a survey which we ran for a client, and where we looked at the smaller schemes, and 40% of them already had DGFs, and another 20% were looking to add them to their current mix. And it's really to solve that key problem that they said they were facing, which was gaining greater asset class diversification, greater market risk diversification. So really, it's those two drivers we see driving that figure over time rather than price.
Now, you've looked a little bit at cost. What's the average cost on a DGF? What's the sort of the range?
The average cost is about 75 basis points. The range can be a bit broader. It depends slightly on which markets are being targeted. So in the more retail end, you're getting prices above sort of 1%. But in the institutional space, really, it's 75 basis points and down. So at the more strategic end, where the strategies are being implemented through more passive type solutions, and the asset allocation is done on a more strategic basis, you're seeing 30 basis points or so. At the more tactical sort of end of the market, the more dynamic end of the market, you're seeing that sort of 60, 75 basis point kind of price range.
And Aniket, we talked about diversified growth funds, but the actual market's pretty concentrated when you look at who the really big players are in it. Could the industry suffer a little bit if one or two of those funds went wrong?
Certainly.
Does that wipe out the concept?
Well, certainly, as I said before, DGF is a brand of some sort. So if something goes wrong with one fund, it definitely could have consequences of on the whole category. But one thing I'd observe is that they are well risk managed in general. So that's one of the key hallmarks of the DGF brand, is that the funds are well managed, especially at the larger end. We do see them being quite well managed in terms of risk. So the kind of vigilance on display, by consultants, I think does kind of give us more kind of security on DGFs, especially as they're so large. But that's not to say that something couldn't go wrong with one of these managers, especially some of these managers employing more complex strategies. That's something that you have to feel very comfortable with, that the manager has the capabilities on board to do that. But yes, it is quite concentrated in terms of the number of funds. But I think some of the larger funds have closed, so that does increase, should lead to less concentration, and especially as the brand kind of takes hold to a greater extent, the concentration issue should start to dissipate.
Okay. Mark, Parry, final thought for you. Are you positive on the outlook for diversified growth funds?
Yeah, I think they can do a variety of things for a variety of different users, be it in DB schemes looking to de-risk or gain access to alternatives, DC schemes looking for a kind of core asset class going forward, existing investors looking just to tilt their risk profile. But it's about fundamentally this focusing on outcomes. Can we deliver a return, in our case of cash plus 4.5%, with less volatility than the equity market? And we think that's a very powerful offering over time.
Gentlemen, we have to leave it there. Thank you all very much.